St. Louis. Welcome to What Retirement Means to You with Jerry Means, financial advisor and founder of the Means Financial Group. I'm your host, Spike Spangle. Jerry, how are you doing this week?
I'm doing great, Spike. How are you?
I'm very good. I understand that you received a lot of phone calls from one of our recent programs where you were talking about retirement risks, and we've had a lot of requests. If you could continue that conversation, talk about even more of them. You got a lot of phone calls from it. People worried out there?
Yeah, we're seeing a big uptick, Spike. I don't know why that is, but, you know, maybe what's going on in the markets, right?
Yeah. It's been a crazy couple of years, tough handful of months. Before we do that, though, and we are going to talk about longevity risk, why living longer can be an issue, especially in today's investment environment. We're going to talk about sequence of returns, what that means, and why that might affect you later in retirement. But first of all, who is the most ideal person to be getting your kind of advice? You've said before there are different kinds of advisors. There's accumulation, and there is what you do. It's not that you don't help people accumulate and grow their assets
Correct.
as well, but your firm has a very specific focus. What exactly is that?
So there's the three phases of money. There's the accumulation phase. This is your working years where you're putting money, socking it away in your retirement plan, whether it's a 401k, a 403b, 457, whatever retirement vehicle that you have through your employer, and maybe you're saving some money on the side, trying to do Roth, contributions and things like that. Those are your accumulation years. You're putting the money in there, you're getting whatever matching that you get. But then once you get into what I call the financial red zone, maybe you're within 5 years of retirement or you're already retired, you enter the preservation phase of your assets. This is where, yeah, you still want to accumulate and get a reasonable rate of return, but you really have an eye on not losing what you've already accumulated. And then you have the distribution phase. This is where you're deaccumulating, right? Because the reason we save this money, all of those working years, all of those accumulation years, is so that when we retire, we can draw off of that and have an income. And we all know that, we can't just rely on Social Security. It's a big part of the plan, but it's just part of it, right? If you have a pension, which we know are starting to go away, but if you have a pension and you're fortunate enough to have one, sometimes Social Security and pension isn't enough. You have to have enough money set aside in some type of income plan that's going to cover the acronym that we use, which is MUG, right? Your mortgage, your utilities, and your groceries. Those are the essentials. You still want to have money to be able to go do the things you want, like travel and golf and that sort of thing. But we want to make sure that we have a guaranteed sources for that MUG, right? We want to fill up your MUG first, right? Then we want to look at, some of the discretionary things that you want to do. So we're looking for people who are really serious about retirement. If you think that you're in that financial red zone within 5 years of retirement or already retired, you've accumulated assets, you have questions like, when should I draw my Social Security? Should I and my spouse draw Social Security? Do we start it at the same time? Do we draw it at 62 or full retirement age, or do we defer it to 70? Which plans do we draw off of first? Do we pull it out of our IRAs first? Do we pull off of our non-qualified accounts? I have a client, she calls it her Todd account. It took me forever to figure out why she called it her Todd account. She meant her TOD account, which is her after-tax account. But she calls it her Todd account. And I kept asking her, who is Todd? It took me a while to figure out what she meant.
Yeah.
Everyone has these own little nicknames for it, right? But that is my goal, is to sit down, help people design an income plan and put it in writing. We want to do a written income plan, have a strategy to understand which portfolios do we pull first? What's the tax advantage or tax disadvantage of pulling from each one? What can we do to help the impact of future taxes? And again, what can we do to make sure that we don't run out of money, which is on everyone's mind. And part of that is controlling your volatility in your portfolio with what's going on in the markets right now.
Right. Well, thank you, Jerry. Thank you for explaining that. That's what you do at the Means Financial Group. But I also have to say that your job has probably gotten harder over the last 10, 15, 20 years. Retirement today is different than it was for our parents, probably even more our grandparents, right? We're living longer than we ever have. Longevity now is talked about as a risk in retirement. Living long and healthy, that's a bad thing today?
Well, I've told this story before on the air, but I think it warrants telling again. But my grandfather was a big influence in my life as far as financially saving and being educated about money. And my grandfather retired early. He retired in his early 60s, and he lived to be age 90. And I'll never forget him telling me, Jerry, this is the longest period of unemployment that I've ever been through, right? Because you really are.
Yeah.
When your paychecks stop and you're having to turn your assets into an income, not only do you have to fill that mug, right, the mortgage, the utilities and the groceries, but you also want play checks along with your paychecks, right? There's things that you want to do. You have to have discretionary
you wanna
funds.
travel. I mean, every day is a Saturday now, right? You're off 7 days a week, so you're going to be spending from that bucket as well.
Correct. And my grandfather was fortunate. He retired from Boeing, which back then was McDonnell Douglas. He had a really nice pension. He had Social Security, he and my grandmother both. My grandmother also had longevity. She lived to be age 95. And most of his retirement interest rates were high, right? So he was getting those 6, 7, 8, 9%, you know, if you go, depending on how far back you go, on CDs. So the only money that he had in the market was some of those discretionary funds, money that he could afford to lose. And that was one of the first lessons that he taught me about money, was that you should only have money in the market that you're willing to see go up and down. It's that simple. Everything else you should have somewhere safe, and you should have that in a guaranteed stream. And it really was the foundation, the philosophy of how I built my business.
Right, but Jerry, if I can ask you, for people who retired a year ago, 2 years ago, 3 years ago, 4 years ago, they didn't have those safe interest rates in bank CDs. We've had market volatility. So how have you been able to help people retire in the last few years? You don't have that safety floor in CDs.
Well, that's the thing, is you have to think outside the box. You have to pivot. You have to be able, financial planning is not an event, it's an ongoing process. So we've had to look at things like fixed annuities with guaranteed income riders, where you can put money with an insurance company, you get some of the upside of the market with none of the downside risk. Now you're capped, so if the market goes up 20%, you might only make 12, but 12 is a reasonable rate of return. But if the market goes down, you're going to get a 0. But over time, you're going to average a lot higher than what those CD rates were paying. So you help combat inflation, but you also can get a guaranteed income stream off of that. And you don't have to worry about pulling money out while the market's down, because you can't lose in those type of vehicles.
Do you think your grandfather today would be interested in vehicles like that? Or it's a different world trying to explain that to folks right now. It's like, well, I want to do it like my parents and my grandparents did, but we can't. You've got to find a different way to explain it to folks.
Yeah, so I was in the business in 1998. My grandfather didn't pass away until 2008, so he did have some of those vehicles. I was able to talk with him and show him that, and he's seen the value in it, so he did have some of those vehicles. But yeah, I just think it's really important for people to understand it's time to think outside the box. We're living in interesting times. I know every generation says that, but all you have to do is really look around and look at, we haven't seen interest rates do what they're doing in the last 30 years, right? Market volatility is on everyone's mind, and the experts don't really know. I don't know what the market's going to do in the next year, but we have to plan for that guaranteed income and only have money in the market that we can afford to risk. People will come in and say, Jerry, I know you can't tell me. I hear this every day. I know you can't tell me, but what do you think the market's going to do over the next year? And I always make the joke. I actually thought about getting a broken crystal ball and putting it on the conference table and saying, you know, the crystal ball is broken. We can take educated guesses, but they're really just guesses, right? The experts don't know either. We have all these talking heads on TV. You can read one article or watch one news station, they'll contradict the next news station. Who really has the answer? No one knows. So you can't plan that way, right? We plan for the worst, hope for the best.
What I always like is that you bring it back to the individual, the family, their plan. There's news and there's noise, but what you want to do is make sure that we keep their retirement on the right track. Can you tell me a little bit about the on-track review before we go out to break?
Sure. So for people that come into our office, or people that call in to come into our office, for the next 10 callers, we're offering a complimentary, no obligation, on-track retirement review. This is for a person that's serious about retiring or who already retired. I call it the financial red zone. You're within 5 years of retiring, or you're already retired and you want to make sure you're still on track to stay retired. We're going to look at all of the key parts of your retirement portfolio. We're going to look at taxes. We're going to look at a written income plan. We're going to make sure that you're getting the most out of Social Security. We want to make sure that you have some type of long-term care plan for longevity issues. And of course, you know, we want to tackle taxes. That's a hot button right now as well. So for the next 10 callers, we're offering that on-track review at no cost, no obligation. Just give us a call, 844-878-1293.
Thank you, Jerry. We'll be right back. Folks, call the phone number you see right here so you can get your own complimentary on-track retirement review. As Jerry said, 844-878-1293. Jerry also just mentioned a word, annuities. Are you using that tool properly? When we get back, right after this break.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to What Retirement Means to You with Jerry Means. I'm your host, Spike Spangle. Jerry is the one who provides us retirement solutions every single week. Thank you so much for everything that you're taking us through today. What about real life solutions? Folks who come in. We're taking a look at longevity. There were a lot of contracts, annuity kind of products. I was saying right before the break. Over the last few years, the numbers haven't been real great. Are you just stuck if you've had something for the last few years? What have you experienced when you do a review with folks?
Yeah, absolutely not. You're stuck. And what you have to keep in mind is the insurance companies, they compete with each other. So they're coming out with new innovations and trying to outdo one another. So sometimes you can have a contract that's only 3 or 4 years old, but it's a dinosaur compared to some of the ones that came out this year with the newer features. If you have one that's 10, 15 years old, you know, absolutely there's more things that you probably can get a higher interest rate. Not guaranteed. We have to look at it, do an evaluation. I have a great story of a listener just like you that called into the show. He was with one of the big box firms, and it was kind of more of a do-it-yourself firm that charged a partial fee. You guys can put that together, who that might be.
I like your discretion here, Jared.
Correct.
Very nice.
So, but he had maybe $2 million with them. And he also had, his wife had about $300,000 in a old fixed annuity. And his wife passed away, and he was reeling from that, understandably. And he called up the 1-800, I call it the 1-800 Who Cares number, because they really aren't sitting across from you. They really may not even know what you look like, right? So he called, got a person, told the situation, hey, I'm trying to file this claim paperwork. My wife passed away. And he got kind of brushed over, even though he had that much money with them, but because it was kind of a do-it-yourself firm with a small fee, they just said, well, just take the spousal continuation option. Now, to put that into simple terms, his wife had an annuity. It was in her name. It was paying a fixed interest rate. And when she passed away, the spouse can take the money out, invest it somewhere else, or it can just continue what she had.
Okay.
And it's literally checking a box, sending in a death certificate, and the contract gets reissued in his name with the same features, same interest rate. Well, my first question was, and he called me because he didn't feel like he was getting the advice that he needed. Mm-hmm. My first question was, well, what's the fixed interest rate? And he said it's at 2%. So in about 5 seconds, I was able to pull up on my computer screen. I put his age, the state, the state that we're in, the amount of money that it was. And I'm able to see the highest paying interest rates to the lowest paying interest rates. And I said, well, why would you take 2% when there's new products out there paying 4 or 5% guaranteed? Not to mention some of these other ones that have long-term care features that you don't have to qualify health-wise. Now, keep in mind, he's 80, right? So he was able to, he could put it in there and get some other benefits. And I asked what the goal for the money was. He said, I want to grow it. I'm going to leave that money to the kids anyway. I don't need it because I have these other assets. I said, hey, we can put a death benefit rider on there where we're guaranteed that no matter what the market does, the value of that's going to grow every single year. But the actual account value is also going to grow at 3% higher than where it's at right now. Well, that was a no-brainer for him. And he said, why didn't they show that to me? And I said, well, because you were calling the 1-800 number, and you know, you get the advice that you pay for, right? And it was kind of a do-it-yourself firm. So he became a client. I helped him before he was ever a client. I helped him with that death claim form. When the money came in, we moved it over, put it somewhere else to get him a higher interest rate. But he also said, hey, Jerry, can you look at all of the other things that I'm doing with them and see if I can help you? So shame on them for not helping him.
Yeah.
But that happens all the time. I see that every day. He had been with them a really long time. It was an accumulation portfolio, but he's not at that point anymore. Right now, he's thinking about legacy, you know, and taxes. What can you do to help me with taxes and legacy? He's fine. He's 80 years old. He's got Social Security, pension. He's doing the things he wants to do. His needs have changed. So again, I say it all the time on the show, financial planning is not an event. It's an ongoing process. You know, so that's where people come in, and we offer that on-track review. And I know we're going to talk more about that. But folks, if you want to call in right now, you can call in. The number's on your screen.
Yeah, you can call in anytime. You don't have to wait for a commercial break. Use the phone number. Actually, another thing that you can do if you want to, use the QR code down at the bottom of the screen. You've all been to a restaurant recently. Open up your phone, go to the camera function, and point it at that white and black box there. If you click on that, you'll answer a couple of questions, and then Jerry's team will get in touch with you, not during the program right now, but at the beginning of the week here, and we'll schedule an appointment for you to come on in. That being said, since you were talking about a client, and this is what you help untangle, what I'm curious is, he was already taking his RMDs, so he's 80-something. What do you think right now about Secure Act 2.0 and pushing out RMDs? Is this a good thing for retirees? Is this better for the government? Or what do you think on Secure 2.0?
So I'm a positive person, but I know that we've talked a little bit about this before. I have a suspicious feeling about, you know, taxes are going to sunset in 2025, and they're automatically going to go to higher rates. I think it's a little bit fuzzy that all of a sudden they're allowing people to defer their required minimum distributions till age 73. See, when I started in the business, it was 70 and a half. And I always hated the half because it confused people. But it was 70 and a half, and it's been 70 and a half forever. Until 2019, they changed it to 72. Now they're saying 73, and there's legislation where it may even go to 75. They want you, in my opinion, to defer your distribution until tax rates are going to be higher, and you're going to pay more taxes on them. We have a window right now between now and 2025 to start doing Roth conversions, to start taking distributions and pay it at a lower rate. Either you or your family are going to pay the taxes on that money at some point anyway. Why not pay it right now at a lower tax rate? I don't think taxes are going to get any cheaper.
You hit the nail on the head there, but I want to ask you more about this Roth conversion. This is a way that people can actively fight against possible rising taxes down the road. I got to take a quick break though. Folks, call for your own on-track retirement review. For the first 10 callers, because we're broadcasting all around St. Louis, we would like to get you into the office. If you're serious about retirement, if you're wondering how your investments that you already have work with Social Security, how to put together a tax-forward thinking plan, what are you going to do about estate planning, meaning are you leaving money to anyone, and how do you cover your medical costs deep into retirement? If that sounds like you, if that's what's keeping you up at night, call 844-878-1293. More with Jerry Means right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to What Retirement Means to You with Jerry Means. I'm your host, Spike Spangle. We're talking about retirement risks again today because it just seems to be a popular topic. But you were talking about a way that your viewers might actually be able to beat the system a little bit, at least as far as taxes. You got to explain, though, what the Roth conversion is. We've been saving tax deferred for 30 or 40 years in our 401ks or 403bs. What is the Roth conversion?
So there's a lot of things that we can cover on the Roth, and we could probably do a whole show just on Roth. But let's just talk about some of the high points. So the basic idea of a Roth IRA is you put money into it now, and there's limitations to how much you can contribute. If you're under age 50, it's $6,500 a year. If you're over age 50, it's $7,500 a year. It's called the catch-up provision. It just got increased this year, by the way. But some people don't qualify. If you make too much, there's income limitations, so that's something that we help people figure out. But then there's also something called a backdoor Roth, where there's a loophole in the tax code where we can help people that make too much money to contribute to a Roth, where they can still get in there and kind of legally get around there through a loophole that they left open. But again, right now, if you look at what the markets did last year, if you have an IRA that was down last year due to the market volatility because of the interest rate increase and your bonds are down and your stocks are down, it's a great time to start thinking about Roth conversions because we don't know, we don't have a crystal ball what the market's going to do, but we know that accounts are down. If you do a Roth conversion, you pay taxes on the amount that you convert over, and there's no income limitation on conversions. And as that market comes back, all of that growth is going to be tax-free because that's the idea behind a Roth IRA. You don't get a deduction when you contribute or you convert, but as the market goes up and over time, you pull that money out, it's all tax-free. Well, in a rising interest rate environment, but also tax rate environment, that can be a great tool. I'll often have people too say, well, isn't it too late for me to do that, Jerry?
Right. Okay, so somebody watching the program, they're 62, they're 65, they're 68 years old. Is it worth it for them to do a conversion?
Absolutely. Because if you think about it, you're not going to do a Roth conversion and pull money out of that right away. If you're 62, we're hoping, or if we look at historical numbers, longevity, you may live 30 years in retirement. So that's 92. Well, you're not pulling all of your money out next year.
Okay.
You're pulling it out over a 30-year period. So why can't you do some conversions now, let that money over the next 15 years grow tax deferred and come out tax free on the back end of your retirement? And let's face it, where are tax rates going to be 15, 20 years from now? Oh. Right? If we know,
I thought you're a positive person. Don't get me thinking about that.
Well, there's solutions, though. That's why we're talking about solutions and things that we can do. And right now, there's a window between now and 2025. Not only can you do conversions while the market is, while your portfolio is recovering and get that recovery tax-free, but we have 2 more years of these lower tax rates before we see the tax increase. So if your advisor's not talking with you about that, it's probably because they're just focused on the accumulation phase and they're not looking at that back end of your retirement and doing that preservation, distribution, holistic plan. They're just accumulation advisors, possibly.
Well, and because you're a nice guy and because you're positive, you won't say this on air. I'll say it for you. We were talking in the lunchroom. You said another reason that an advisor might not talk to you about it is because if you've got $500,000 in an account and you want to do a Roth conversion, you've got to pay the tax. That means that now you might have $420,000 or $400,000. That means that that advisor now has less assets under, so they're not inclined to want to tell you about it. But for you, it's in your client's best interest to do a Roth conversion. That's why you talk about it here on television.
Absolutely. I'm in the long game too, right? I mean, I want to have longevity in my career. That's how I've been able to do this 23 years. And as an advisor that's held to a fiduciary standard, you're supposed to put your client's best interest first. So how can you not talk about tax planning and tax advantage? You know, there's a reason when you get in the car that the windshield is much bigger than the rearview mirror, because what's in front of you is a lot more important than what's behind you. And in tax planning, it's the same thing. When you go to your accountant and you're doing, you know, tax preparation, the year is over. You're just filing the return. There's not a whole lot that you can do.
And one of the big problems there is that most folks go to their CPA and say, I want as much money in my pocket this year as possible. and we're not thinking down the road. You've said before that you've needed to sort of retrain CPAs who work with your clients and say, hey, I'm looking at the long run. I'm looking down the road. I want them to have more money in their pocket 10, 15 years from now. Okay. So the hard part with the Roth conversion, do you do it all at once? Because I mean, like you said, we got about a 2-year window. Somebody's got $500,000, $750,000, $1 million in an account. Do you do that now?
Most of the time, it's going to make sense to do that over a period of time. Definitely over the next 2 years, because like we mentioned, the tax rates are going to be lower than they're going to be 2 years from now. But even 2 years from now, there's still going to be opportunity to do conversion over a period of time. You have to be careful doing it all at once because you're going to roll into a higher tax bracket. It can cause your Medicare premiums to go up. There can be some disadvantages to it. But in some cases, I've had clients where it made sense to kind of bite the bullet the first year and deal with some of those things just to have that growth over time. So everyone's different. And that's why we offer our on-track review to our clients to come in to find out what strategy is best for them, because it's not a cookie cutter decision.
Before we wrap up today's program, can you tell me about all of the elements of the on-track retirement review? It's not just about taxes. I mean, that's one element, but you've said so many different things in today's program. Maybe we could put it all together in a bundle.
Sure. So when clients come in, what we're going to offer is our on-track retirement review. And we're going to offer that complimentary at no cost to the next 10 callers. Just call the number 844-878-1293. When you come into my office, the first thing I want you to do is be comfortable. We're not there to judge you or what you've done in the past. We're not going to pick on your current advisor. We're going to sit down and get to know you and find out what it is that you're concerned about, why you're in the office, what it was that brought you in, that made you pick up the phone. There's a reason when you do that. There's something that you're concerned about. If you're watching this show, there's probably something that you're concerned about. Pick up the phone and call us so we can help you with that. We're going to look at the tax planning. We're going to look at longevity planning. We're going to look at your health insurance, taxes. We're going to do a written income plan for you. And we're going to look at the volatility in your portfolio or the risk in your portfolio and make sure that you're not taking any undue risk, that you have the right amount in that bucket. So give us a call, 844-878-1293.
Thank you so much, Jerry. We're going to be back again next week. Folks, call for your own on-track retirement review. As the title of the show says, it's about what retirement means to you. It's different for everyone. So get your own on-track review, customized for you. 844-878-1293. For Jerry Means, I'm your host, Mike Spangle. We'll both be back again next week.